Welcome to Bill's Market Insights. Today we are exploring a paradigm shift in wealth management. Our session is titled The AI Singularity and US Debt Instability, the Great Wealth Migration from Safe Haven Traps to Productivity Sovereignty. This is the first installment of our Asset Allocation Series, focusing on the logic of repricing as the old debt paradigm collapses. The global macro environment has reached a historic fault line. For decades, we lived in a world of low interest rates and low inflation. That era is dead. In its place, we find a structural, high-rate environment fueled by deficit monetization, geopolitical friction, and the AI revolution. The traditional 60-40 balanced portfolio isn't just underperforming, it's obsolete. Today, we redefine your margin of safety. Let's look at the systematic revaluation of debt. We are moving from guaranteed income to a risk epicenter. First, sovereign debt. With the US fiscal deficit becoming a black hole and energy inflation rising from geopolitical tension, treasuries have entered a secular decline. The strategy here is clear. Divest from long-term nominal bonds and shift toward short-term nominal bonds and TIPS, inflation-protected securities. Second, corporate bonds. We are facing a credit sandstorm. AI is rewriting business models so fast that legacy cash flows are evaporating. Even investment-grade companies are at risk if they can't adapt. And a word of caution on AI infrastructure debt. Beware of the depreciation trap. High-leverage computing centers may see their hardware become obsolete before the loans are even paid off. In this new landscape, avoid zombie credits that lack an AI moat. Now, let's pivot to the valuation resilience of AI assets, what I call growth gravity. You might expect rising rates to crush tech, but AI leaders are showing a unique immunity. When a company's profit growth, represented as delta G, far outpaces the discount rate cost R, that equity stops behaving like a stock and starts acting like a super physical asset. Investors are currently front-running the productivity dividend. Even if the macro data hasn't fully captured AI's impact yet, the market is already pricing in the next decade of intelligent revolution. This expectational gap is where the core opportunity lies. But AI doesn't exist in a vacuum. Its inflation bedrock is energy. The endgame of AI is power. As deglobalization continues, the scarcity of energy, specifically copper and power infrastructure, will keep a floor under interest rates. Assets that hold pricing power over these core resources are the physical fortresses that will protect you against the devaluation of paper currency. There is also a human element to this shift, the silver singularity. Modern medicine has handed us a 20-year longevity dividend. For the silver elites, aged 50 to 70, the investment horizon is no longer short, it's another 20 to 30 years. This forces a risk transgression. The old strategy of shifting to bonds in retirement is now financial suicide. To survive high inflation over a longer life, older investors are being forced back into growth-oriented assets. So, how do we build the portfolio? We recommend a Trinity layout based on risk contribution. 1. Core AI equity. Overweight at 25%. This captures the singularity premium and provides the high growth potential. 2. Physical assets. Overweight at 25%. Gold, energy, and AI-related commodities act as your anti-inflation fortress. 3. Dynamic strategies, a 40% benchmark. This is your flexible hub for capturing macro alpha. But a strict rule here, low leverage. We want to avoid liquidity crunches while treating idle margins as short-term, yield-generating cash. Finally, let's talk defensive lead. We're keeping this underweight at just 10%. Stick to short-term treasuries or TIPS if you have the liquidity, and consider floating rate notes so you can exit fast if rates spike. That said, be ready to pivot back to long-duration bonds the moment recession risks start to tick higher. In an era of fiscal decay and technical singularity, a mediocre defense is just a prelude to bankruptcy. Remember, longevity is risk and debt is impairment. To reclaim your capital sovereignty in this perfect storm, you must embrace the productivity leverage of tech and the stability of resource assets. Stay vigilant. I'll see you in the next part of this series.